Hello, hello. Welcome back.
Hello, welcome.
Welcome to episode 20 of Living Richly with Curo. So happy to have you back again for another week of fun. My name is Anne McCabe. I am the CEO and a partner here at Curo Private Wealth, and I'm joined as always by the lovely Teresa.
Hello, I am Teresa Roberts, COO and partner here at Curo Private Wealth. Thanks for joining us.
Yes, thank you for joining us. We're going to be talking today about an interesting topic. I'm actually really looking forward to the back and forth with you on this. We typically so far have kind of focused our podcast on more what I would call evergreen sorts of topics, but today is very timely. Today, we're going to talk about the election that's coming up. In case you didn't know, we have a big one coming up here in November. And specifically, sometimes the urge to want to do something crazy in our portfolios, like go to cash ahead of the election.
Right.
So we're going to talk about how we approach that as advisors with clients, how we think about that. That is our topic for today. But before we do that, let's do a quick A-team catch up. So how is your week going so far, Teresa?
It's going well. It feels a little bit like the calm before the storm this week, as far as my meeting schedule was a little lighter. But then I look out over the next 2 weeks, and like next week, I have a day where it's 3 or 4 meetings all in the same day. So I'm just trying to take this week to enjoy a little bit of the peace and the quiet, get some of those long list items checked off while I've got some time. But overall, it's been good. It's been, really hot recently, so haven't been getting outside much, just staying in the AC. But other than that, doing pretty well. How are things in your world?
Yeah, things are good. I definitely agree with the hot thing. One of my girlfriend's husbands is in Houston, Texas this week,
Ooh.
and it was warmer here in DC than in Houston, Texas, if you can believe that. That's when you know it's really hot in the area, when we're hotter than Texas. I mean, I'm pretty sure we use that as like a saying, right? Like hot as Texas. So
Yeah.
I don't know. DC is becoming the new Texas, but yeah. Aside from the heat wave that we are getting, my week is going well. It feels insane that we are already in September. I
Right.
can't quite wrap my head around how fast the year is going, how fast the summer went. So I am really, as much as I possibly can, trying to just stay in the present, not think about the past, not think too much about the future, but just like really try to stay present. So that's what I've been focusing on. As you know, I was on vacation recently, so I came back to a lot of crazy and a very busy meeting schedule. So I just have the storm. I don't have any calm right now, but it's been a good week.
Good.
Yeah.
Good to hear. Yeah, I had to slow one of my friends down. She made this random comment like, what are your plans for Christmas?
Oh dear. No. It's not even
Christmas?
Halloween yet. No.
No, relax.
Yeah, no.
Relax. We'll talk about Christmas in 2 months. I can't even imagine. I can't even think that far ahead at this point. So I'm with you. Let's stay present.
Yeah, exactly. But it'll be here before we know it.
Of
So
course. Of
crazy.
course.
We're already talking about like business planning for 2025 and budget planning for 2025. And yeah, let's just get through.
Yeah.
I don't know, get through the next
Yeah.
couple of months. Yeah.
Yeah. One day at a time.
One day at a time. All right, so let's get into our topic of the day. And, politics, political situations, I think can bring a lot of emotions to the table. They can bring a lot of uncertainty, especially depending upon where you fall on the political spectrum. If
Right.
you're concerned that your candidate is not going to become president, I think that can tend to make you want to do some crazy things. So,
Yes.
the reason that this topic came up is we have had some conversations with clients. A lot of questions have come up about the election. What does it mean to us as investors? What should we do about it, if anything? And then, as you know, Teresa, I had a conversation earlier today with clients who actually wanted to go to cash ahead of the election. Yeah,
My goodness.
I know. And the conversation always starts like, I know what you're going to say, Anne. And I'm like, okay, well then, why don't you tell me what I'm going to say?
Right.
Why on earth would you think that that is what you should do? But it is this just very sometimes deep emotional,
Right.
very irrational reaction. So I want to hear from you, Teresa. How
Mhm.
do you coach clients through what can be just a very uncertain and emotional time? And how do you coach clients with, how to separate your political views from investing? And if you did have a client come to you and say, I just want to go to cash, how would you approach that?
Yeah. Well, I think you used the right term in coaching because we talk a lot about how so much of our job as advisors is also a part behavioral therapist, right?
Yes.
We deal with planning and investments, but it's also about coaching clients to understand market cycles and what they mean. So, and again, I've had these conversations before. They popped up even during 2020, right? During the COVID pandemic and the height of it when the market was selling off, people start to panic. So usually where I start is acknowledging the feeling, right? I never want our clients to feel like we're dismissing or discrediting their concerns because I do think that election season is a very polarizing time, specifically in the US. And a lot of what the media does is play on emotion, right? Pull on people's fears and anxieties. So you have to remember that clients have experienced months of this, right? Leading up
Mm-hmm.
to November when it's actually time to show up at the polls. So I never want to dismiss the anxiety or, that anxiousness or fear that they might be feeling. But I do think that the other side of the work that we do, we're part behavioral therapists, but we're also numbers people, right? And you and I, we've seen the data, we've seen the research, we've seen the facts. And I guess it's probably, I feel hypocritical saying it because I'm also an intuitive person. So again, I register with that gut feeling, but I also think that a part of coaching clients through it is presenting them with the data, right? The real historical facts about how markets behave during election cycles. And when you can show them that, right? When they can show that, because again, it doesn't matter which side of the aisle you happen to fall on. Typically, in general, market performance is agnostic to who is in the White House. But I think being able to show that historical data to clients and visualize it for them, one, I think it helps ease the concern. But even bigger than that, even bigger than the charts and the graphs, is also to remind them that we are maintaining a long-term perspective about the way that we manage money. We are not going to make decisions about a portfolio you have spent the last 10, 20, 30, 40 years building. We're not going to make decisions about it based on what we think is going to happen in the next 8 weeks. It's just
Right.
not logical. It doesn't make sense, right? You wouldn't make a decision about, huge lifetime decisions in your life just based on the short-term facts. So I think showing them that data, but then also encouraging to remember that we're in this for the long haul. And I mean, you and I think this firm, we're pretty good at what we do, right? We're pretty good at the way we do planning, at the way we manage money. And we're always proactive, right? We're always proactive. We're always planning for the volatility, planning for the hard times, planning for the challenges. And if clients will just trust us to guide them through, then I think that they will be okay. We know that they will be okay. It's just trying to convince them that they
Yeah.
will be okay. But that's usually how I try to approach it. And different than COVID, because COVID, I did have a few clients who insisted. They insisted that we go to cash. Luckily, one of those clients is still our clients, and they learned that very hard lesson
Yeah.
by missing a lot of the correction. And now they're like, yeah, no, I'm listening to you, here on out. One of the clients does no longer work with us, but even had to admit at that point, like, oh my God, I should have listened. So when you
Yeah.
can draw on that historical experience, I think it helps settle them a little bit. But yeah, that's generally my method to how I have those conversations.
Yeah, I love that. And not surprising, we're very similar in our approach. I mean, one of the things too, in addition to hearing the concerns and empathizing, and in some cases agreeing, like, yeah, this
Yeah.
can be emotional, and we
Mm-hmm.
also feel uncertainty sometimes when
Mm-hmm.
we don't know what's going to happen. But I also think like drilling down to what is the actual concern
Mm.
that you have and like helping clients articulate that concern. So in the case of the conversation that we talked about earlier, one of the things that they mentioned is, we're so scared that we don't have time to make up for any losses that we experience. These clients are fully retired. They are taking distributions from their portfolio. They don't have the ability to put more money into their portfolio anymore because they're not earning employment income anymore. So that was concern number one, is we just don't feel like we have the time to recuperate any losses. Totally valid, right? Totally valid.
Right. Absolutely.
The second concern was back during the financial crisis, we lost 50% of our portfolio, and we don't want that to happen again. Now, they were not working with us during the financial crisis. And so I was able to say to them, okay, I don't even know exactly what their portfolio was during the financial crisis, but I can assume that if they lost 50%, they were probably close to 100% in stocks, right? Because from peak to trough during the financial crisis, that is what the S&P 500 went down. So if you experienced a 50% loss, you were likely fully invested in stocks.
Right.
We don't have them fully invested in stocks. So I was able to say to them, based on history, as you said, we're constantly looking at history, at not that you can, guarantee future results from past performance, but based on what we know in history, we have a very high likelihood that even if we do hit a downturn in the market, your portfolio is not going to go down 50% because we're not fully invested in the market for you.
Right.
And then one of the other things they said was, yeah, we just have such a short time horizon. And I'm like, no, you don't. Your time horizon, God willing anyway, right? Like your time horizon is the rest of your life. Are you planning to take everything out of your portfolio this year? Because if you are, then yeah, we should probably go to cash and, liquidate the entire portfolio and send it to you. But that's not what I understand your plans are. So I think just helping for people to really take this emotional, very fear-based thing that they're feeling and allow them to articulate what is the actual concern, and then how do we combat that concern with an actual plan, I think can be really helpful too.
Yeah, no, that's a really great point, is to try to dive to the heart of what they're afraid of. And again, it's why we have centered what we do around planning. And I think being able to direct them back to the plan, right? To redirect and say, no, wait, let's take a look at what we've laid out. And again, your time horizon is much longer than you're giving it credit for. And we have laid an investment plan in place. We've laid a cash flow plan in place to make sure that you don't outlive these assets, even through the worst of times, right? So I think using the planning and directing them back to the plan can maybe add some reassurance to some of the fears, especially fears around, we don't have time, we're going to run out of money, we can't afford to lose 50% of our portfolio, which again, completely understandable, but it's not what we do, right? And it's not the way we manage money, and it's not the way we do planning. So it can be tough conversations to have, though, when people are really emotional. And sometimes I just want to scream, like, turn the noise down.
I know.
Turn the noise down a little
bit.
You don't have to listen to every news broadcast and because I think it just helps to stoke the fears in people. And sometimes you have to turn down that background noise and really hone in on what's important. And to your point, I think lots of people feel anxiousness and some nervousness around this election cycle. Again, we become very polarized as a country. So it's not to be unexpected, but at least I know that that's what works for me, is just turning the background noise down some and really focusing in on what matters and what's real, right? What's really happening, and not what I'm just feeling emotionally about it.
Yeah, absolutely. I mean, I think turning off the news in some cases, especially if it's affecting you so much that you want to do something that deep down you probably know and your advisors are telling you will be detrimental to your long-term financial position. If it's affecting you that much and making you want to take action to that point, you should probably turn off the news until things get a little bit less crazy, because it's not good. It's not good for any of us, right? And at the end of the day, the media is there to sell advertising. And one of the best ways that they sell advertising is by getting our eyeballs on their material. And human nature is such that we are attracted to the negative. We're attracted to, the blood and the gore, and we're attracted to the more dramatic
Right.
articles, and those are just not good for us to read, especially when we're talking about, what it means for us as long-term investors. So I think also one of the things, and we talked about this with these clients today, one of the things that I think we do really well is, especially for our clients who are in the distribution phase of their life and they're no longer working, we proactively manage the cash portion of their portfolio, I think, quite well. And so I
Mm-hmm.
also reminded them that, yes, the majority of your investments are allocated, they're invested, but we have, for this particular client, we have quite a bit of cash set aside for their income, to protect that, right? So that
Right.
when we hit a downturn in the market, not if, but when, their income will not be impacted. So I do think that if you're listening to this and you are retired and you're living off of your income, or sorry, your portfolio as income, there are some things you can do. You can be proactive. So we're not saying, don't do anything and just kind of let it ride. Any cash that you may need in the next 12 to 24 months, that should be in very short term, like money market, very short term bonds, very conservative sorts of investments, which we do for clients. So back to your point, Teresa, I think it is really getting clear on the time horizon. If you need any of these funds in the next 12 months, yeah, we agree. They shouldn't be invested in the market because anything can
Absolutely.
happen in the short run.
Yeah, and we're also in a great yield environment. I mean, how much
Yes.
longer we don't know, but we're in a great yield environment now. So even in our portfolios, we have leaned a little heavier on the cash side for clients who are in distribution phase and are drawing income, where we may have been holding 6 to 12 months before, it probably looks more like 12 to 18 or even 12 to 24, depending on how much income they're taking. Because we do get the advantage of much higher yields on our money markets and CDs and savings accounts and those kind of things. So yeah, I agree. Don't be afraid to plan that, hey, I'm going to need some money in the next year. I don't want to risk the markets being in free fall when I go to take it from my portfolio. So we'll put that money on the sidelines now.
Yeah, exactly. And
Yeah,
also
I do
we're
sorry,
selling at
go
a
ahead.
good time. No, I was just gonna say we're also, if we are raising cash for folks right now, we're selling at a really good time. I mean,
Yeah.
it's 2024, the first half alone, the S&P hit 31 all-time highs. So, it's a pretty darn good time to raise cash and sell some things if you need to, generate some cash.
Yeah, I think it's also important that we talk a little bit about the why not. Why not go to cash, right? So if because we've had clients, at least I have in the past, who have been insistent. And
Yeah.
even though I can tell them, oh, this is what I think you should do, there's also the why it's terrible. It's a terrible decision. How do you what are your responses to that why not? Like what could go wrong by us going to cash?
Well, my favorite thing, and I was giving these clients a hard time this afternoon. My
Hmm.
favorite thing is people will always say, "I'm not trying to time the market, but I want us to go to cash and we'll get back in when fill in the blank." And I told
Right.
them, and I said, before I said this, I said, "I want you to know we've been working together for a long time and I adore them." And I said, "Before I say this, I want to tell you this comes from a place of love. But don't tell me you're not trying to time the market. That's exactly what you're trying to do. Let's just call it what it is, right?" And they started laughing. And
Exactly.
I said, "I love you all. This is from a place of love, but I have to keep you honest." So, we had a good laugh about that. But and it happens all the time back during COVID. Like, I'm not trying to time the market, but I just want to go to cash and I'll get back in once we have a sense for what this global pandemic thing is going to look like, right? And
Yeah.
it's always the same sort of spirit. So here's what I tell folks, and this is something that we disclose from the get-go when somebody hires us, is we do not believe that we or anybody else can properly time the markets. And when we say time the markets, you have to make two decisions. You have to
Exactly.
decide when you're going to sell, and then guess what? You have to decide when you're going to get back in. And that is really, really hard to do. I mean, both are hard to do, but it's even
Hmm.
harder, I think, to make the call to get back in. And so in the past, when I too have had clients who I, couldn't convince to stay invested and they've gone to cash, a couple of times we've come up with a proactive plan of, okay, here's our discipline. When these triggers are hit, we will get back in. And even in the case of one client I'm thinking of, they never got back in. The triggers were hit and they were still too scared. They were like, no, but let's wait until this, or it's always something, right?
Right.
And so number one, we just at our core do not believe that anybody can time the markets properly. Secondly, if you look at the long-term returns of the market, they are exceptional. But guess what? In order for you to experience those returns, you have to be in the market. So there's all sorts of data around the best days happen around the worst days. And even if you miss the best 10 days out of a 20-year period, you're talking about a massive decrease to your investment returns. So those are some of the things that I say is really you have to make the call to get out and you have to make the call to get back in, which is impossible to do. And then just by being out of the market, you're missing out on such great returns that you otherwise could be experiencing. And we can't time the market. Nobody can. And so it's important to make sure that we're in the right portfolio to begin with, that you're comfortable with, and that you understand, yes, when the market goes down, your portfolio will go down, and that they're committed to understanding that when that happens, they're not going to do something like want to go to cash. So I think these conversations have to happen even before there is some sort of bout of volatility or before we're having, these conversations. But I mean, even still, like the client said, we know what you're going to say. So it's not like we haven't been consistent in what we're going to say. They just need to, sometimes hear it again. So how about you? Why do you tell?
No, it's the exact reason you mentioned, is because how then do we make the decision on when to get back in? Missing the best, even a handful of the best days of market performance dramatically affects your performance to the downside. So to your point, it's easy to call getting out, especially in a year like 2024, when the markets have just been going up. It's easy to say, okay, we're comfortable. We'll take some of the gains off the table. We'll go to cash. Well, then how and when do we decide to get back in? What are those decisions? And I remember in 2020 saying to the client, okay, you're insistent that we get out. You have to make the call on when we go back. When we go back. And to your point, we would reach out like, okay, I think we should talk about, and they kept pushing it off and kept pushing it off. And if you remember 2020, I think we hit the low, maybe end of March, early April. I can't remember the exact date.
I think it was the exact end of March, basically.
Yeah. And then the market did a V-shaped correction. It just shot straight up. This client didn't get back in until November of that year. And it missed so much of that upward momentum, right, of the market that year. So that's always
not to mention when did they get out? March?
Right. Yes.
Okay. So here's the important part. You're selling in March. S&P was down 34% over 33 days. Yeah. So you're locking in losses of 34%. And now you get back in November. I can't remember what, December was, but S&P ended up 16% in the year of COVID in 2020. So you were still negative. I don't know, call it probably close to 30%. So this client who sold in March and got back in November's returns for 2020 were, call them, negative 30%, versus somebody who just rode the waves and did not sell was up 16% if you're fully invested in the S&P 500. I mean, you compound that, it's a massive difference.
Yeah, absolutely. And then I also try to explain that it goes against the fundamental idea of investing. Nobody starts investing so that they can buy it higher and sell it lower. I mean, the traditional foundation of investing is to buy low and sell high. So why would we start to sell things, especially during 2020, when it's headed downward? When he could have just held on and would have been fine. So I think it also goes against, I think, just our philosophy in general. And one thing that you and I have always agreed on when it comes to our clients is that they have to be able to trust us, right? That's the part that we work really hard to do. And the way we manage our clients, the way we manage our relationships is to develop that trust. And I think if we get to a place where we just are fundamentally just divided on the best way to proceed, then it means, I think, that there is a lack of trust in the relationship. And then another conversation needs to be had about whether or not we're a good fit for one another.
I think
honestly,
you're
which
absolutely
is
right.
unfortunate, right? But you pay us because you trust that we're going to do what's best for you. And you and I are, we want to be successful, right? We want to make money, but we also really care about our clients. We care about our team. We want to do the best for them. And we're never going to give advice that we don't think is not in your in your best interest. So,
Right. Yeah, absolutely. I mean, we do. And we eat our own cooking. Everything that we
yes.
tell clients is how we approach our own money management. And yeah, I mean, integrity is top for us. So we will never, ever
No.
tell somebody to do something that we don't absolutely believe is in their best interest. So the last thing that I love to share with
Mhm.
clients is I always say that volatility is the price that we have to pay to get the exceptional returns that we do in the markets. And
Mhm.
what I mean by that is, if you look at the long-term returns of stocks versus bonds, cash, fill in the blank, gold, the
The
dollar,
dollar.
whatever, right? Exactly. The stock market is the best performer over the long run, hands down. And there's a price to pay for that. And the price to pay for that is, if you look historically, 25% of the time, the market is going to be down in a year, which means that 75% of the time, the market's going to end up. This is, data based on history anyway.
Mhm.
And so, as investors, in order for us to get those exceptional returns, we have to pay a price for that. Otherwise, everybody would be doing it and we wouldn't make any money, right? I mean, think about the
Right.
investments that are guaranteed, secure. They don't pay us a lot of money. Yes, we're
No.
not losing money, which is great. They make us feel good. We see our balance like, okay, our money market is like slightly growing, but we're not going to make a lot of money in those sorts of investments. And so we can't have our cake and eat it too, right? If we want the exceptional returns that we have historically gotten in the stock market, it means we do have to pay a price. And
Yeah.
3 out of 4 of the years we're going to make money, right? But one of those years we're going to be down, and that is the price that we pay. And in my opinion, because the market has been such an exceptional performer, over the long run, I think it's a small price to pay. But if that price doesn't seem worth it to you, or it keeps you up at night, or you can't stay invested, then I'm just going to tell you shouldn't be invested in the markets, because
Right.
volatility happens.
Yeah, absolutely. And for long-term investors, I think there's even a way to see the volatility as a benefit, right? When the market's down slightly, when you have a long time horizon, that just means things are on sale, right?
Oh
And who
yeah.
doesn't love a sale?
Yes, exactly.
I love a discount. So for investors with a long time horizon, dips in the market could also present opportunities. And it doesn't mean you want to buy every dip. That's not what we're projecting. But what you can start to think about is that when things pull back, when there are small corrections, the market is resetting itself, and there could be opportunity to get into different positions at a discount, at much cheaper than you would have bought it when things were soaring. So I think it's about the time horizon, and remembering that we're not making decisions for your lifetime portfolio, right? Based on what's happening over the course of a few months. You wouldn't make any other decision that way.
Right. Exactly. Yeah. We always say the stock market is the only market where, when things go on sale, people don't buy more, which is so strange. And in
Yeah.
any other market, or, purchasing situation, you tend to buy more when things
Yeah.
are on sale. So I think that's great. Yeah. And we encourage our clients, especially those who are in the accumulation phase, to, as you said, Teresa, embrace volatility. We
Hmm.
want volatility. We're not so excited about volatility for our clients who are in the distribution phase, but for
Right.
those folks who are investing, you want volatility. Volatility is your friend, and you'll make a lot more money over the long run as a result of having volatility. So
Yeah, absolutely.
all right. Well, I think that probably sums up. Hopefully, we're very clear about where we stand around the election and what you should do about it as an investor. And certainly, hopefully, that we do not think that any long-term investors should go to cash ahead of the election. That is something we do not believe would be in
No.
anyone's best interest as a long-term investor. So that wraps us for our topic today. But what about a closing thought?
Well, again, in the light of the election, I'll stay sort of on this path in general. Just turn the noise down. even if it's not just about your investments. I think that as adults, we have to make informed, educated decisions about our representatives in government. But I also think that you can become informed and do it in a way that is not constantly stressing you out and keeping you up at night. So turn the noise down a little bit. And I say even that around the investments. I always tell clients that if it makes your tummy hurt to see the volatility, then stop looking.
Yeah.
Right? You don't have to log in every day, right? You're working with us. We're always watching and monitoring and paying attention. So if it gets to be too much, just don't look today, right? It can be okay. And that's how I just feel in general, is that be informed, get educated, make sure that you're making decisions that speak to your best interest, but don't get so caught up in a lot of that emotional, polarizing, big media headlines. Don't let that wear you down. We still have a while to go before actual election day, and you will drive yourself literally insane if you are plugged in constantly to those headlines and to that noise all the time.
Yeah. Exactly. I think it's about us controlling the information that we're ingesting versus it being thrown in our faces without any sort of, permission or whatever. So yeah, I totally agree with that. So my closing thought is going to be similar around the election and just the conversation that we've had today. If you haven't looked at your long-term financial plan in a while and you have some of these questions or some of these thoughts around how am I doing or what should I do as a result of the election, this is a great reminder to check in on your financial plan. We should be looking at our plans, certainly in the case of a big life event or life change, but also just kind of, once a year, check in and see how you're doing. Chances are that things are probably looking better if you haven't looked at your plan in a while, because performance, if you've been invested anyway, performance has been better over the last year than we use in our projections because we're a bit more conservative in our projections. So I think it's a good time. We're almost to, we're definitely in the second half of the year, but we're almost to Christmas, according to your friend, Atrisa. So good time to check in and just make sure everything looks good.
Yeah, absolutely. And if you don't have a plan, it's probably a nice reminder as well that planning is important, especially when you're making decisions for retirement and for, things that are happening down the road. So it's important to start planning if you haven't been doing it. Absolutely. And of course, Curo's here to help.
We are. We would be happy to help. We love planning. We love planning. We nerd out on that every day.
Yes. No.
So. All right. Well, thank you again for joining us for another week. This is our weekly reminder to send us your questions to podcast@curoprivatewealth.com. We'd love to answer your questions on the podcast. If we do answer your question, we will send you an Amazon gift card as a thank you for taking the time to send in those questions. If you have had a conversation recently with a coworker who was like, oh my gosh, this election, I think I'm going to send all my 401k to cash, please do them a favor and share this episode with them. You will be doing them a massive favor that could literally change their life. Not exaggerating. So share this episode with them. Please make sure to give us a review. Let us know what you enjoyed about the podcast.
5 stars.
Subscribe. 5 stars. Of course. 5 stars. Subscribe so you know when we drop new episodes, which is every week. And again, thanks so much for joining us. Until next week, we will see you then.
See you later. Live richly.